Okay, dear students, good morning.
Morning.
Let us start. I want once more to return to this slide because this is a bit short to understand completely. So let's calculate a very simple example. Suppose a firm has earnings of $3 and a dividend of $1.5, and suppose that it applies a constant retention rate of 50%. So every year it plans to pay out 50%. And then we may ask, ourselves, what is the implied earnings growth rate and what is the implied dividend growth rate? Simply because in the formula we are asked to input the dividend growth rate, and that's of course this one. So we first think about this one, and then we think about that one, and this is all we assume. Any idea how to proceed? Well, the change of earnings is, of course, earnings right now minus earnings next year, with a minus sign. So earnings today is 3. Earnings in 1 year is 3 plus 1 point. Oh, sorry, one important thing was missing. 3 plus 1.5 times something. We invested $1.5, what we paid out, and this, of course, earned money. So one thing that we forgot the 15% return on investment. We have to make an assumption, otherwise we can't proceed to calculate. And when we think about this, the change in equity is, of course, 3 times the retention rate. That gives us 1.5. So the 3 cancel out. This gives us the 1.5 times the return on investment. In this case, this is 50% times 12%, 15%, so it's 7.5%. This here, this is earnings times retention rate times return on investment. We have the last earnings, plus we have the amount of investment times the return on investment. So the change in equity is simply this. And now of course we want to understand what is the value . What is the value of the share? We know that we have to apply this constant growth formula, so we still need the R here, and we should specify this a bit more. We should call this the required return on equity, or the cost of equity, the rate that the capital market expects. So we should add this somewhere. ROE, let's say 12%. So first of all, yeah, now let's get back to here. Yeah, we have the change in equity. Oh, sorry, this as E times retention rate times ROE, and this is okay. And then if we calculate the relative change of equity, of course, this goes out. And that actually gives us precisely this. The earnings growth rate, retention rate times investment on your equity. Yeah? So you just can start from scratch basically and see that the E wipes out and this is left over. So we already solved this. Yeah? The relative change is retention rate times return on investment. Now the dividend, yeah, when dividend equals 0.5 times earnings, yeah, if this grows by 10%, then this must also grow by 10%, yeah, because all you do is multiply everything with 5%. Yeah? So this is the same thing, retention rate times return on investment. Yeah, easy to figure out. Yeah, and then the price, yeah, is of course 1.5. Okay, the growth rate is now the same thing. So it's again, where was it? 7.5%. So many pencils, but nothing was really strong. This one. So 12% minus 7.5% gives us 1.5 divided by 8.5. And if I remember correctly, this was 33. $33.3. So we just applied this Gordon growth model for a specific stock with some numbers. And we found out that the value of the stock is basically a function of all the 4 input parameters that we gave there. And now, please have a guess. Suppose we would increase the retention rate. We would pay out less. We would pay less dividends. So this 1.5 becomes smaller. But of course we invest more, so the earnings growth rate is likely to increase. There is one effect that reduces the price, another effect that increases the price. Which one is dominating? Can you please think about an intuition? Will the stock price go up and down? Less dividends, that's bad. But more investment, more growth, that's good. Which one is dominating? All you are asked is basically economic intuition. You basically look too mathematically on this. You don't have to look at the formulas. Or basically, I give you one advice. All you have to look at is compare these two numbers. Why is this giving us the result? Economics is basically sometimes complex models, many numbers, but the essence is just 2 numbers. So my my conjecture is that simply because 50 is bigger than 12, how would you translate this into normal words?
It's what we do the investment.
Exactly. Yeah, investment is a good thing in this model. Yeah, because the cost of capital is only 12%, but the investment yield 50%. Yeah, so the investment adds or creates value. Yeah, this is a good investment. Yeah, so you should do as much as possible. Actually, you should not pay out any dividend and invest everything. Yeah. Let's simply try out. I didn't do it myself yet, but suppose retention rate is 2/3. Then the dividend is only $1, and the growth rate is 2/3 times 15%. Oh, that's easy. That's 10%. Yeah, if we plug this in, we have 1 divided by 2%, and that is $50. Yeah, so an easy recipe to make money. Yeah, if you're an investment banker, yeah, you will of course describe this in a much more complex model. Yeah, but your intuition basically tells us if you want to show your customer how to increase the stock price, given that the investment is yielding higher returns than the cost of equity, of course you want to invest as much as possible. And you can bring it even further up. 2/3 is far away from 1. And if you increase the retention rate to 1, then of course you have 0 dividends. 0 divided by anything, the stock price goes to infinity. Strange enough, mathematics sometimes has its own limits, but the more you invest, the better it is. So this is clearly value increasing. And then one last thing. What happens if we put this here to 12%?
So,
what does it mean? It actually means that the firm does not have value-creating investments. But these are also not value-destroying. It is just neutral. And a neutral investment does not destroy value, does not create value. So our gut feeling tells us it should not affect the stock price at all. You can invest or you cannot invest, it doesn't matter. And let's try this out. So with our 50% retention rate, we have the value of a share equal to 1.5. This is the dividend. And then we have to calculate this growth rate. This is the retention rate times the ROE. So this is 50% times 12%. Minus G. This formula, 12% is the return on equity, minus the growth rate, and the growth rate is of course retention rate times return on investment. So this is 50%, 1/2 times return on investment, 12%, and we end up with 1.5 divided by 6%. And this, if I remember correctly, was $25. Now the same thing with 2/3. With 2/3 you have $1 left as a dividend, because 2/3 is paid out. You have still 12% as the required cost of equity, and then we have to subtract the new growth rate, and this is then 2/3 times 12%. So this is 1 over 4%, and this is again $25. And this is almost like a little miracle, but of course it follows exactly our economic intuition. And that's no surprise. And when you sit in a final exam, or when you're a banker and sit in front of your complex spreadsheets, of course you don't see the beauty. You don't see how simple it is. You always have to really lean back and think, what is the intuition? What should I expect to find? And the intuition is, when investments do not generate value, but also do not destroy value, then they must not matter. Whatever complex your spreadsheet is, you calculate something. The simple model shows you, and your intuition shows you, that it should not matter at all, and you should have no impact. And of course, if you put a 15% in here, you can easily guess that the more you invest, the better it is for the stock price. So you are a private equity fund, you have a firm that you analyze, and you have complex spreadsheets with thousands of numbers in it, but you know upfront. All you have to do is to bring up the investment, and of course, this uses 15%, that it really adds value, and then in the end you will have a positive effect on the shareholder value. And little formulas, retention rate times return on your investment, these are key concepts that practitioners basically have deep in their mind. This is something that they really have memorized, and they know when to put it out. So they sit in an evening conversation, dining with friends, and all of a sudden they say, oh, I have this formula, take the envelope, write something on it, and say, this is how we make money. It's not coming out of complex algebra. It's simply something that they really have deep insight, and they know when and how to use it. And of course, the more you use it, the more you get used to it. The most important thing is that you don't lose your intuition. Before you actually start something, you already know the outcome, because you basically you know precisely that investment adds value if it has a higher return than the cost of capital. And if not, it cannot add value. And if you calculate something, then you first must make sure that the calculations are correct. And if the obvious doesn't come out, then there is an error in your calculations. You can easily make all kinds of mistakes and errors in your calculations. So first check for the basics, and try to get a good feeling for the numbers, and then you can continue. So you get basically a new understanding of this simplified slide here. If a firm wants to increase its share price, should it cut its dividend and invest more, or should it increase or decrease the dividend? And very clearly, it only depends on the difference between this and this. And again, as a theory guy, I would say, if you assume that all value increasing investments are done anyway, then the dividend doesn't change anything. If you know for sure the dividends, the investments, yeah, then you know the size of the cake. Yeah? The firm is nothing else than a cake full of cash flows. Yeah? And these cash flows are distributed to the capital market. Yeah? Or in many firms, we have the idea of an apple tree. Yeah? An apple tree is the firm, it grows, yeah? And then you have apples, and the apples are nothing else than dollars. Yeah? In good years, you have many dollars, in bad years, you have less dollars. Yeah? In autumn, they all fall down. Yeah? And the value of the firm is the value of the apple tree. It is just the expected amount of apples. Yeah? When and how many. Yeah? But, yeah? And then investment simply means that you add a new branch to the tree, yeah? And it will have more apples. Yeah? Or you put fertilizer on it. Yeah? So, yeah? But once you know what the tree is, yeah? Once you know the investment portfolio of the firm, yeah? You know precisely how many apples will fall down with what probability. Yeah? And that is the value of the firm. Yeah? And if you, in our examples, yeah, we always assume if we pay out the dividends, we can't do the investment. Yeah? Which is, of course, a contradiction to theory. Yeah? Because if you invest it anyway, yeah, if you can make 50% here, yeah, you should make it. You should do it as much as possible. Yeah? Even if investors force you out to pay this out as a dividend, they would say, okay, then I need alternative methods to do this investment. Yeah? So I have to raise money by selling new shares, or I have to go to a bank and ask for a bank loan, yeah? Because my policy requires me to do all good investments. Yeah? And of course, we simply assume that the investment is there. If it's there in an unlimited amount of value, yeah, then this is a money machine. Yeah? The share price goes to infinity simply because if you can create value without any bounds. Yeah? There is no limit of capital, and it's always 50%. Yeah? And this, of course, this is like a money machine. Yeah? It does not exist in reality. Yeah? In reality, you have a nice investment opportunity that yields you 15%, but you can invest only 1 million or 1 billion, yeah, but no more. Yeah? You can't invest an unlimited amount of money, yeah? And therefore, of course, this is a highly simplified little example. Yeah, so this. Okay, so. Yeah, now let's go to this example here. When we think about a firm, yeah, we may think about an apple tree or a cake, yeah, or in the simplest case, we just think about $100. Yeah? The firm is nothing else than $100. Yeah? And the share price is obviously $1. Yeah? By the way, a practitioner would strictly reject this. Yeah? A practitioner would always say, if the firm has nothing else than $100, its share price would be no more than maybe 90 cents. Yeah? Simply because there was lots of empirical evidence, yeah, that the share price is less than $1. Yeah? There were empirical exercises to understand. Yeah? You look at different firms that have more or less cash, and you try to basically answer the question under the same conditions. Yeah, if you control for everything else, yeah, what is the marginal or incremental impact of the cash? And this whole literature, yeah, you may Google for the value of corporate cash holdings in Google Scholar. You will find there are many articles that basically say it's only 90 cents. Yeah, and the intuition is quite simple. If you just assume there was a 10% probability that the manager steals the money and runs away, then of course it is a 10% basically reduction. Or you simply say running a stock operation has a lot of fixed costs. You have to hire a manager, and if the manager is paid, he will basically eat 10% of the money. And therefore, if the firm has cash, this fixed costs of running the firm are simply too expensive, and then we lose the value. But in theory, of course, we are quite simple. We simply say, let's assume perfect markets. Now, if you pay out a dividend of $10, this is $1.1 per share. Then and P1, the price after the share price, would obviously be 90 divided by 100. 0.9. But P0, the price that you pay today, and today I mean always before something happens. The price today is of course 0.1 plus 0.9, $1. If that firm, this is the firm, nobody knows anything, so everybody says $1 is the price. Now the firm announces a dividend of $10, and shareholders will say, okay, now I will have only a share worth 90 cents, but I have the dividend, so I expect, this is basically the value that I expect. Ignore discounting here, this happens in the short-term future, so there is no discounting effect. Of course, usually you would have say, P1 is, in our models, P1 is usually in 1 year, and then you would have to discount this by 1 year. But let's say this is basically tomorrow, and there was no discounting. So it's $10. Okay. If the shareholders now go to the shareholder meeting and say, we want more. We claim for a high dividend. Because we believe that this firm is always paying too low dividends. And suppose they are successful, then of course the calculation is absolutely unchanged. Of course you can pay out $50 here, then there are still 100 shares remaining, they will be worth 50 cents. And you get 50 cents a dividend plus 50 cents as a share price. So what is the bottom line of the argument? Increasing or decreasing the dividend doesn't have any impact, at least for our small firm. And of course we did some assumptions. And the assumptions is simply, we say there were values worth 100 and they stay 100. Or they stay, well, basically we say the value of assets in T0 is $100 and the value of assets in T1, after paying out the dividends, is 100 minus the dividend. You just take out the dividend, and that is the reduction of the change in the assets. So this is a very simple left pocket, right pocket. The shareholders are the owners of the firm, but they have two pockets. One is their share, and one is their own investment. So basically they take money out of the one pocket, out of the firm, and they put it into the other pocket, which is their private cash holdings. Overall, no change at all. Now, let's assume a share repurchase, and we can only conjecture that it will not change the matter at all. It's $50 used to repurchase shares. Then the assets that we made will be $50. Yeah, so the P1 this always stands for the number. Yeah? The number of shares goes down to 50. Yeah? There were 100 shares now. Yeah? They are trading at a share price of 1. Yeah? If the firm takes 50 and buys the shares in the share market, it will basically have $50 and 50 shares. This is how the balance sheet looks like. And now, interestingly enough, what happens with these shares? In every textbook of finance, basically you have the implicit assumption that the firm looks like this afterwards. Yeah? These shares are simply destroyed, wiped out, because they are booked here and booked here. They're basically double entries on the balance sheet. You own them, it is a liability and an asset, you can simply wipe them out. So every finance professor will basically tell you the number of shares goes down to 50. This is why I wrote this down here, because I don't even think about this. For me, this is basically an automatic kind of thing. P1 is still $1. $50 divided by 50 shares. Okay, and now, what is the price at the beginning? So you own this one share of $1, and the firm just announced a share repurchase of $50. You don't know, with a probability of 50%. Your share will be purchased or not purchased. The firm randomly basically purchases 50% of its shares. You are a shareholder. You may either lose your share because you sell it, or you may hold your share if it's not purchased. If it's purchased, you get $1. If it's not purchased, you also get $1. So it doesn't matter at all. The share price is still $1. It's only that the whole firm is shrinking. Less dollars, only 50, divided by less shares, only 50 remain. So the intuition of this is basically finance is extremely simple. If you just take the firm as a pot of cash, 100 or 50, or as an apple tree, or as a cake, and this cake or the apple tree changes only by taking out something, giving it to shareholders, then under perfect market conditions, it will basically have no value generation or no value destruction. It is just a little bit of calculation on how the share price is affected. Sometimes it goes down, sometimes it goes up. Sometimes shareholders lose their share because it's repurchased. Sometimes they keep onto the share. But these are all value neutral transactions. That's the basic idea. And then if you think about how do you think about what we had before here, the price per share is dividend divided by ROE minus growth. This was, of course, the dividend per share. And if we have share repurchases, the number of shares change. And therefore, all these calculations become more complicated. And if you suppose you have a dividend of $1 and a share repurchase of $1, and the earnings of $3. This was our example before. The firm before had $3 in earnings, and that paid out dividends. We can simply add a share repurchase. But if we would do so, we would have to think about in this model what will then be the dividends per share, and we have to account not only for how much earnings do we have, but we distribute them no longer among 100 shares, but among less shares. And that will obviously complicate our calculation. Practitioners basically do it very simply. They say, let's, instead of valuing one share, let's value all shares. This is the present value of all shares. So initially we have 100 shares. We know that dividends and share repurchase is just two different ways to pay out money. By themselves they are value neutral. So you can simply do so as if the share repurchase would be paid as a dividend. That goes the same. So we just add total dividends plus share repurchases. Because in the end, nothing is different. Good morning. So what is called here the total payout model is simply another simple cookbook receipt in order to prevent tedious calculations. In order to prevent in this kind of calculation, to basically look at, calculate the dividend per share in the future, accounting for the change in the number of shares. Just assume that it is an extra dividend, and assume that the shares outstanding do not change. So basically, consider yourself to be at T0 today, when we have still 100 shares, and simply treat the share repurchase as a dividend. If you compare a dividend of $50 to a share repurchase of $50, one thing stays the same on the asset side. The assets are reduced by $50. You take $50 out of the corporation and pay it to the capital market. The only difference is here you have equal treatment. Everybody gets 50 cents, and his share price is reduced. Here, 50% get $1, 50% get 0. But that's not unfair, because we trade at fair market conditions, so there is no unfair treatment here, and everybody is basically the same off. It's both without any value implications, besides the obvious fact, of course, that the firm is $50 left. Money has been taken out of the pocket where you have your stocks in, and put into the pocket where your money is at. Always think that shareholders have two pockets. One is filled with shares, and the other is filled with cash. And of course they add both. And so this is just an easy practitioners received, to apply those formulas still, where we assume a constant number of shares for simplicity, in a situation where, strictly speaking, this is no longer valid. The number of shares goes down. And also for a practitioner, the practitioner basically quite often doesn't even think about, is the payout done in shares, by share repurchases, or is the payout done by dividends? The only interesting thing is how big is the payout. Then I have to reduce the assets accordingly and account for this in the firm valuation. Okay, and now we go to what investment bankers today do. They basically use the so-called discounted free cash flow model, and they basically value the enterprise. Remember, what we call the enterprise is actually what we call assets. Every firm has assets and also some cash, equity and debt. When we value the shares, with the dividend discount model, we basically look at this, and we take formulas where we value the share and we have in mind the return on equity, the cost of equity, and we think about the dividends, the cash flows that flow to equity. If we value the assets, basically we look at the whole firm, and we say, obviously, the market value of equity plus debt minus cash is the enterprise value. And if we think that this here is the present value of future things, cash is easy. The value of debt can also be thought as the present value of future payments. And then the enterprise value is, of course, again, the present value of future cash flows. But now we think about the cash flows that these machines here produce. Very much like the cash flows that the project produced yesterday. And this here is an interesting interpretation. When you buy a firm, and this actually emanates from M&A, and mergers and acquisitions. This is the most prominent reason when practitioners value an enterprise. You want to take over Vinca, because it's almost bankrupt, shares are trading low, and you think this is a good investment opportunity. Of course, it is controlled by a family, and let's assume there were many, many shareholders that own VinFast. They are all extremely frustrated about the share price performance. Everybody is selling, and you think the share price is too low. It's actually a bargaining price. All you have to know is to buy all the shares, get control, invest some money in order to make this a profitable business, and then you can make a lot of money. Then you think of what is the value of VinFast. And you think of VinFast about as the machines that are right there now. As you know, VinFast is not making profits at the moment. So you have to think about, do I have to change something? Sometimes I just have to wait until the profits come. Because they have invested into electric vehicles, they are not easy to sell yet. Just wait a couple of years, and then you see the profits, or maybe you have to invest and say this is not yet a profitable business. But anyway, you have to suppose you say these assets have a certain value under a certain investment strategy. So if I have control, if I invest $1 billion and turn this around the company, then these assets will have a value of something, and then minus my investment is what I have to pay. And then you can compare with what you have to pay. What you have to pay is, if you can purchase all the shares at the current share price, you pay this, and if you add that, then it is basically the purchase price. Investment bankers simply can compare the purchase price of something with the value that they receive from this. And in an M&A, in a takeover situation, of course, you would not assume that you have to pay only market value. You can buy single shares at the stock market, currently at $4. That's the share price of VinFast. But of course, if you want to acquire the majority of shares, you have to make a takeover offer, and the shareholders will usually require a premium. So in a takeover situation, you would say, dear VinFast shareholders, I make you an offer, I pay you 20% above the current share price, but only if more than 50% of you agree to sell, because I want control over that firm, and I need 50% of the votes, otherwise I can't change the firm with my purposes. And 20% is an attractive premium for shareholders, so maybe 50% say yes to this, and then you obtain control. And then basically you pay the market value of equity plus 20%. And then why do you have to pay also debt? Take off all debt. That is the assumption. And of course this is quite natural. Suppose VinFast has loans. It is loans to a bank based on the assumption that the current owner stays the owner, and that the current situation of VinFast doesn't change dramatically. If somebody that is unknown acquires the firm, if he does big changes in the firm, the risk will change, and the bank will say, I want my money back, because the assumptions are no longer met. Quite a lot of bank loans have so-called change of control clauses. Let's write this down. Or basically two words. This is change of control. This is material. Adverse change. Actually, this is the more prominent thing. A MAC clause is simply a clause in the debt contract that says if there is a material change, and a change of control is usually included, but also is included a strong change of the character of the organization, which may make it more risky. As a bank, of course, you're very interested in the risk, and the material adverse change is everything that could increase the risk of the debt, the bankruptcy risk of the firm. So you basically put some clause in the contract that says if there is a material adverse change, and maybe you add some examples, for example, a change in control, for example, a substantial change in the assets of the firm, then the bank must be repaid immediately. This bank loan usually is repaid after 10 years, but in an adverse change scenario, I want my money back immediately. And that is normal. Almost all loan contracts and also bond contracts have it. And therefore, if you buy an enterprise, somebody would take over VinFast, he must be prepared to pay the market value of equity plus a premium, the premium that is necessary to convince shareholders to sell, plus he must pay back the debt, because the banks would usually say, I want my money back. Of course, the private equity firm or whoever buys this will then go to another bank and say, look, this is my restructured firm, would you willing to finance 50% of the new firm with equity? It's VinFast new versus VinFast old, and the VinFast new quite often has more debt, so the debt risk is increasing. The banks will say we want more interest rates on this new debt, but of course there will be new debt. But this is now basically a new firm with new debt contracts. And of course the acquirer can simply take out the cash of the firm, and will usually do this. And when we value the firm, when we value a firm, basically we think about the machines, we don't think about the cash. We treat the cash as an extra item that we get also in addition when we buy the machines, it's something separate. So this enterprise value is basically what you pay for an enterprise. If you take over VinFast, and you compare this price that you have to pay with the value that you derive from it. Yeah? And the value is basically the present value of future free cash flows. Yeah? When you buy these machines, yeah, and these machines produce cash flows, right? You forecast the cash flows and you say, from this method, how much do you expect to earn from this? Yeah? So value in the enterprise is very much like value in the project. Yeah? The formulas did not change at all. Yeah? This is precisely the same that we already had for the project. Yeah? So the machines produce cars, yeah? And producing cars creates earnings before interest and taxes, yeah? And unlevered net income is 1 minus, multiplied with 1 minus the tax rate. Yeah? And always think that unlevered basically is in a situation where you basically say, this is not yet decided. Yeah? For the moment, let's just put one large E, and let's assume it is unlevered. Yeah? We only concentrate on these cash flows. Yeah, and then of course, somebody who acquires VinFast must make it, well, will have some plans how to make it profitable in the future. You know, Mr. How's he called? Warren or so, the owner, he already invested, yeah, 1 billion last year, yeah, so he had his own idea. Yeah, he's of course controlling. Yeah, he will say, okay, I have to invest a lot of money in order to make this really a modern, profitable factory. This is my capital expenditure. In the future, I will also need some inventories, yeah, some short-term capital, and then this is basically the free cash flows that these assets produce. Yeah, and this cash flows, of course, yeah, in an all-equity firm, it is distributed only to equity, but in the real world, of course, it is distributed to both debt and equity. Yeah, so today's value of the firm is simply the future free cash flows of the firm, and it basically gives you the value of the assets. Yeah? And when we say firm, actually we mean the assets. Yeah? We do not mean debt or equity, and we do not mean cash. Yeah? We only think about the firm, yeah? And we think that the firm is something like a machine or an apple tree. Yeah? The apple tree produces cash flows. Yeah? The machine that produces VinFast cars in the ultimate end also produces cash flows. Yeah, and then the fair value of one share is basically the value of this machine, yeah, adjusted for cash and debt, yeah, gives us the present value of the equity divided by the number of shares, yeah, gives you a fair share price today. Yeah, so if you And if you find that this price is much higher than today's share price in the capital market, this is a takeover candidate. Yeah? Takeovers are nothing else than trying to find undervalued firms, acquire them, yeah, and change them. Yeah? And don't forget, this future free cash flow of the firm is of course coming from some plan. Yeah? This is your planned capital expenditures. This is your planned growth of the firm. Yeah? If you see the share price today is much lower, yeah, then the most obvious reason is you plan to double the size of the firm, yeah, and with twice the size it becomes much more profitable. Yeah? But currently the firm is only half the size, and currently there was no way to increase the size. Yeah? If many firms basically have restricted access to the capital market. Yeah? Many firms that are taken over of these firms that have growth opportunities, or well, they make losses, and they could prevent losses if they grow by 100%, but unfortunately they have no ways to do this. Yeah? They would have to convince their shareholders, yeah? Please put, yeah, everybody pays in $10, yeah? Then we have enough money to double the amount of machines and then become profitable. Yeah? But if you do this in a situation that VinFast is in right now, yeah, most shareholders will usually be very skeptical. Yeah? Suppose VinFast has thousands of small shareholders. Yeah? They will say, VinFast has been an only disappointment. Yeah? We bought the shares for $20, and now they are trading at $5 only. Yeah? So we lost 3/4 of our money, and now you want us to pay an extra $10 to this share, yeah, just to make it more profitable. Now, most shareholders are very, very frustrated, yeah, after making losses, and basically resist. Yeah? And the fact is, of course, they don't have an idea. Yeah? They don't believe the numbers here. Yeah? The acquirer of the firm basically paid a lot of money, yeah, for all kinds of consultants that did the valuation. Yeah? Investment bankers, consultants. Yeah? And he basically believes firmly, yeah, that VinFast is a great company, yeah, that after investing $1 or $2 billion, yeah, after increasing the size of the firm, it will become profitable. Yeah? But the shareholders do not. Information asymmetry is the core of everything in the financial markets. Yeah? You can only create value by acquiring a firm, yeah, because the old shareholders have different beliefs from your beliefs, or have different information. Yeah? The old shareholders are frustrated, yeah, and are not willing to grow the firm, yeah, and to invest more money, yeah? But the new shareholder basically is, based on his information. Yeah, and of course, yeah, we now have to use free cash flows. Yeah. We take the cash flows that go to equity and debt holders. Yeah. Think this here as the I tend to think about this as the capital market. Yeah, there were investors that buy securities of the firm. These may be bonds, then we call it debt, or that may be shares, then we call it equity. Yeah? But basically, they are the investors, yeah? They are the capital market investors, and the firm basically has to think about, yeah, how much money can I get from the capital market, or do I have to pay back from the capital market? Yeah? And just ignore, for this point of time, whether it's debt or equity. Yeah? And that is basically the difference to payables. Yeah? If you have payables and receivables, yeah, this is a part of working capital. Yeah? It's also a liability on your balance sheet, yeah, but this is not, yeah, what you have to pay back to the capital market. Yeah? If you acquire a firm, when you value Continental, yeah, you may have to think about what is the debt, yeah, of the firm. Yeah? And here you have debt and payables, yeah? And that is something different. Yeah? And on a real world balance sheet, you have hundreds of different positions on the liability side. Yeah? And every position you may say, is this debt or is it something else? Yeah? Basically, well, equity and debt is sometimes difficult to distinguish, yeah? But debt and non-debt other liabilities are also difficult to distinguish. Yeah? And all what you have to think about debt, yeah? Is it the capital market that invested? Yeah? Is there an investor that bought a bond in order to make money from this bond? Yeah? The payable is clearly not this kind of thing. And the same thing, and what we had here, paying off all the debt. Is this a debt holder that has a change of control or material adverse change clause? Yeah? If you buy a firm, basically, all bank loans must be paid back, yeah, simply because it's in the contract. Yeah? But the payable, your firm, yeah, does not have paid yet its last order of inventory. Yeah? This doesn't have a material adverse change clause. Yeah? You simply take it over. It is a part of the firm. It's basically a part of the assets, basically. Yeah? Investment bankers treat this payable as a part of the assets. Yeah? If you have machines that produce cars, yeah, then having, yeah, you don't even only have assets, yeah, but you also have some receivables here and some payables there. Yeah? It's a side consequence of running a car machine, a car producing machine. Yeah? And then this is a part of the assets. Okay, so you think about the free cash flows, the cash flows that are produced by the machines in order to flow to the capital market. Yeah? Not flow here, not flow there, to the capital market, that's by equity. Yeah? And you calculate, and then you use the so-called weighted average cost of capital as the discount rate, and the weighted cost of capital. We will dive into this in more detail later on. Yeah? But think as the average cost of capital between debt and equity. Yeah? Simply because if you assume this will be an all-equity firm, then you basically waste a lot of money. Yeah? Because debt allows you to reduce your tax bill. Yeah? Only stupid people would run a firm without debt. Yeah? Because it's a gift from the fiscal authorities, that the overall tax bill can be reduced. If you acquire a firm and think about, even if you're the only investor, you take over VinFast, and after this you can say, case one, I have 100 VinFast shares in my pocket, the new VinFast, or case B, I have 50 shares and 50 bonds in my pocket. I'm the only investor, I own everything, but I own both the bonds and the shares. I still, since I am the capital market, there was nobody else, I get all the cash flows, that's for sure. But with the second calculation, basically means that you get more cash flows. Simply because one consequence is there was less tax payment, and therefore more cash flows left over for the capital market. Then the aggregate cash flow will be higher. And the weighted cost of capital basically is accounting for this. Tax means that there is more cash to be paid to all capital market investors, simply because cash is actually divided between three parties, the fiscal authorities, the stockholders, and the bondholders. And the fiscal authorities receive less if you have debt, simply because the interest payment is reduced from in your income statement, so you have less profit, tax is 20% or whatever of profits, so there is less tax to be paid. If you pay less taxes, there must be more left over for the capital market investors. And so, this way basically is something like the average cost of capital between debt and equity, and it is the magical trick to account for the fact that we save taxes if we use debt, and therefore, for the WACC, you need something like what is your future debt to equity ratio after acquiring the firm, how much debt are you going to use, and you will see this will then basically impact the tax savings, and therefore impact also the value of the firm by impacting the WACC. And in a practical situation, when somebody, suppose VinFast has no strong shareholder, it is a widely held firm, and somebody takes this over, then he would basically ask an investment bank and a consulting company and maybe an audit firm like PwC or KPMG, please do a due diligence of VinFast. Calculate your expectation of the future opportunities and risks. Usually have all three, plus legal advisors, plus tax advisors, and they basically all analyze the firm quite intensively and then say, okay, you need to invest so much money in order to modernize the whole thing. You must hire a new management team, you must do whatever it takes. And then they divide a plan, usually for the next 5 or 10 years, but no longer. McKinsey and KPMG are good for forecasting the next 10 years, but never beyond. It's simply impossible. Even beyond 5 years, it becomes more and more difficult. In the end, of course, most firms have own plans from which you start, and then you adapt these plans to add new things that you invent, but few people plan beyond 10 years. So this value of the firm, quite often you say, imagine I sell the firm after 10 years, then I have one basically last cash flow, and it's basically the value of the firm in this year. And this is called terminal value, and the terminal value is quite often calculated with the Gordon growth formula. That's one obvious candidate to do so. So you use, you treat this value as a very much like we did here. The dividend is basically the free cash flows that you receive. WACC is your capital cost, and then you need the growth rate of the free cash flow. And if this is the last free cash flow that you estimate, and then this n plus 1 is of course the free cash flow times 1 plus g. This is just the one more. This is always P0, and this is always dividend 1. So when you apply this formula, always remember this is 1 year later than this one in these formulas, otherwise it doesn't work. So here in this formula, this is n plus 1, but we have only n. So we take this n, multiply by 1 plus g, and then we have the n plus 1. So, straightforward to do this. And by the way, this is precisely what you will do with Continental over the weekend. This is, and as an investment bank, of course, you have prepared spreadsheets where you just have to plug in the numbers, and then everything is automatically calculated. So the Gauss discounted cash flow model basically is very similar to capital budgeting. The only differences are the following. The firm's free cash flow is equal to the sum of the free cash flows from the current and future investments. And when we value a project, we basically have only one project. This is one investment, the current investments. You see the firm right now, there are machines that produce VinFast cars as of today. And this is not making profits. But you have new investment opportunities there because now that batteries have become cheaper and technology better, if you invest more, and then you have more investments. As an investor, you buy the whole firm. You buy everything that you see now, but you also get all the cash flows from things that will be done in the future. The professors usually are very simple and basically say, suppose I know everything, the whole future. VinFast started 10 years from now, and it will end maybe in 100 years. If I know precisely all the investments of the future between now and 100 years, when the firm is basically dying or ending its life, then basically I have just a sum of projects. This is supposed to be realistic. Nobody knows what happens in 15 years from now. But it's clear that the future investments also play a big role. In particular, when a private equity firm takes over, it really thinks about what can I do in order to increase the firm's current assets. And quite often this requires investments, but sometimes it's just firing people. Think about Elon Musk. He did not invest a lot of money into Twitter, but he fired lots of people. So that could also be a change. And then I basically value the firm's current assets after I decided to fire 90% of the people. And then, of course, the question is how much cash flows are still produced after getting rid of all these people. So the firm's value is the net present value from existing projects and new projects. And of course, including how to run these projects, with how many people. So every individual project is basically a contribution to the enterprise value. You can basically see the firm as a cake, and you cut the cake into 12 pieces, and you call these 12 pieces my 12 projects. But the value is just the sum of these 12 pieces. And these values should hopefully simply add up. Yeah, and of course, in order to maximize the share price, what is the if you buy the firm, you will run it on a profit maximizing basis. But profit maximization is of course not the ultimate task here. You want to generate value. Profit maximization is the goal in a purely simple world, where time value of money doesn't play a role. Profit maximization translates into value maximization in a world where you have capital markets and shares, and where the ultimate goal is basically to increase the share price. Private equity funds do nothing else than they see, here's VinFast shares trading at only $5. If I buy them, if I restructure the firm, if I put more money in, if I change the management, whatever, the share price will be 50. And then I can buy the shares for 5, I can sell them for 15, and I have a multiple of 3. And then after the deal is executed, if everything goes right, the private equity shareholder will say, we made 3 times money. For every dollar invested, we got $3 out. And this is the only thing, and it comes from these kind of calculations. So, if you calculate the present value of dividend payments, like we did in the very beginning, then of course we take the cost of capital of equity as a discount factor. Here is the return on equity minus G, and we get the stock price. And it works wonderful as long as the number of shares does not change. When the number of shares change, because we have these share repurchases, then we better use total payouts. We just take share repurchases and dividends as one, as the payout. We also discount with the equity cost of capital, and then get the total value of all shares. This was when we don't solve for the value of one particular share, we solve for the value of equity. We basically value all the 100 shares and say, I don't care how many shares are there. All the shareholders are entitled to some cash flows, and that is this trick with basically equal treatment of shares, of dividends and share repurchases. And the free cash flow model is, of course, you apply the weighted average cost of capital, because you buy the whole enterprise, you buy the assets, you follow this enterprise value, and if you have tax savings, then the value of these tax savings will, to be shown in the future, will be reflected in the stated average cost of capital. That is the whole thing. In the cash flows are the cash flows of an all-equity firm. Remember, this is unlevered net income. So when you calculate the cash flows, you implicitly assume that you pay too much taxes. The tax benefit. That there was no tax benefit, and in the weighted average cost of capital, you will basically account for the tax benefit. So we see. And I think this is it. And it's time for a little break. Let's have a little break and then go on to our cost of capital topic. How long shall we make the break? 10 minutes?
10 minutes.
Okay, 10 minutes.